Lance Roberts here with 3 minutes on Markets and Money, talking about why after a decade, investors are back to even. What do you mean after a decade? Markets are at a record all-time high. That means certainly investors have been making money. That's the theory of buy and hold investing, which is that no matter what the market does, goes up, goes down, eventually markets always rise and you wind up making money. Well, that's not always the case. Yes, in theory, it works, but in reality, it's a vastly different thing because during bull markets, investors tend to make a lot of mistakes that are revealed during a bear market decline. They pay premium prices during a bull market, which eventually winds up with the buying high, selling low syndrome because they panic. As markets decline, every investor has a point to where they will get out of the market at any price. For some, it's 20%. For some, it's 30%. For some, it's a lot more. But at the bottom of the market in 2008, investors were panic selling to get out of the markets. Volatility is often ignored, and a spike in volatility is what leads ultimately to panic selling in the markets. And finally, ignoring market analysis. Investors tend to want to only find things that justify their idea that markets are going up. This is called confirmation bias. They ignore analysis that contradicts their opinion. But here's the point. Investors have a pension problem. It's the same problem that pension funds face all around the country, which is assuming high rates of return in order to limit the amount of contributions that are made to the markets. In other words, investors want to believe that the markets can bail out their lack of savings. Well, here's the way this actually works. If you take a look at the market from the peak of 2000 or 2007, yes, investors fundamentally got back to even in 2013. But over the course of the history of that 20-year period, investors failed to meet their rates of return that were required to meet their financial planning goals. Here's the way this looks. In 2000, if I invested $100,000 in the market and got a 6% rate of return, this is what the curve looks like. In 2007, that same $100,000 investment at 6% compounded annually grew to be $200,000. That's a good return, right? I mean, we made money in the markets if you got those rates of return. The reality, though, is far different. What happened with investors, that $100,000 investment in 2000 or at the peak of the market in 2007 has failed to meet those rates of return required to meet financial planning goals. And in fact, after a decade, investors have just now gotten to even of what their financial plan stated at the peak of the market in 2007. Unfortunately now, with the markets overbought, extended, and overvalued, the risk to investors is that another decline from this point is going to set those retirement and savings plans back to where they were previously. This is 3 minutes on Markets and Money, talking about the real way that money works over time. I'm your host, Lance Roberts.